Warm welcome, IAS aspirants, to Rungta IAS Academy's quick, high-yield explainer. I'm Faculty A, and today Faculty B and I are unpacking an absolutely crucial GS3 economy topic, the fuel paradox.
Hello, students. Yes, this is one of those incredibly dynamic topics where international relations literally crash right into our domestic fiscal math. We're going to break down exactly how global geopolitics is impacting our oil marketing companies and what that actually means for India's macroeconomic stability. Let's dive straight in.
Here's a quick look at our structure today. We'll be starting with geopolitics and crude prices, then moving on to OMC losses and fiscal math, checking out fuel demand and LPG hikes, and wrapping up with some vital GS3 interview perspectives.
All right, starting with Section 1, Geopolitics and Crude Prices. Now, as aspirants, you already know that India's macroeconomic stability is incredibly sensitive to global flashpoints. You've heard the saying, when West Asia sneezes, our economy catches a cold. Well, escalating tensions in that region have now dragged on for over 60 days. This is heavily affecting the Strait of Hormuz, which is absolutely crucial because it's a narrow choke point handling a fifth of global energy trade. Any disruption there sends massive shockwaves right through the global supply chains.
And we are seeing those shockwaves immediately in the data. Because of these shipping disruptions, crude oil prices are just spiraling upwards. At the time of this report, benchmark Brent crude futures for July 2026 jumped 0.7%, sitting at a really concerning $100.75 per barrel. To show you the tangible threat to India's own energy security, let's look at the numbers shared by Opish Kumar Sharma from the Ministry of Ports, Shipping and Waterways. There were 13 specific India-flagged vessels caught right in this Strait of Hormuz situation. We're talking about 5 crude oil tankers, an LPG tanker, a chemical products tanker, and a few others. So you see, this isn't just abstract international news. These are our assets and our energy supplies at direct risk.
Let's move to Section 2, OMC losses and fiscal math.
So how does this global trigger actually hit home? Well, it brings us to a fundamental GS3 concept you must know. Under-recoveries. It's a massive paradox. Our oil marketing companies, the OMCs, are forced to buy crude oil from the international market at these inflated rates, but they aren't selling it at those higher rates to the Indian public. Instead, the retail selling rate is intentionally kept lower to protect consumers from sudden inflation.
But there's a huge financial cost to this protection. Right now, OMCs are incurring under-recoveries of around 30,000 crore rupees every single month across petrol, diesel and LPG. Essentially, they are losing that much money. It is a staggering bleed on their balance sheets.
To try and alleviate this tremendous pressure on the OMCs, the central government had to step in. They reduced excise duties on retail fuel. But here's the catch for your mains examination. This fiscal intervention comes at a steep cost. The government is forgoing revenue of 14,000 crore rupees in just a single month. You have to connect this directly to our fiscal deficit math, because the government's revenue receipts are taking a massive hit just to stabilize the market.
Let's check out Section 3, Fuel Demand and LPG Hikes.
Shifting our focus to the micro level, let's analyze domestic demand using provisional data from the Petroleum Planning Analysis Cell, or PPAC. Look at this stark contrast in April's year-on-year consumption. Petrol consumption shot up by a solid 6.36%, but diesel consumption, it barely moved, rising only 0.25%. This divergence is a very important indicator of underlying economic activities that you definitely need to keep an eye on.
At the exact same time, we're seeing compounding inflationary pressures on cooking gas. Back on March 27th, the government had to step in to regulate the allocation of bottled LPG to commercial establishments, restoring it to 70% of pre-crisis levels. Because of this, the market saw some severe price shocks. On April 1st, there was a massive hike of 993 rupees on commercial LPG cylinders. And then, right after, on May 2nd, a 261 rupee hike hit the 5-kilogram free trade LPG. From a socioeconomic perspective, you must note that these specific hikes heavily impact migrant populations in urban and semi-urban areas who completely rely on these smaller cylinders.
Finally, Section 4, GS3 Interview Perspectives. You have the data, but now you need the analytical perspective for your personality test.
Exactly. We want to leave you with a highly probable UPSC interview question to think about. How should India balance consumer protection with OMC financial health during global energy crisis? You really need to synthesize the macro data here, like the 30,000 crore rupee OMC losses and the 14,000 crore rupees of foregone government revenue, with those micro realities of migrant workers facing sudden LPG price hikes.
Think carefully about the long-term sustainability of these under-recoveries versus the immediate, pressing need to curb domestic inflation. Structure your thoughts around this framework, aspirants. Thank you so much for joining us for this explainer. Keep analyzing, keep connecting those dots, and we will see you in the next session.